Something fundamental has shifted in the financial markets. Not a rumor, not a prediction, not clickbait. A shift that seasoned analysts have been monitoring quietly for months, and that now demands your attention whether you hold silver, stocks, bonds, or cash. If you own silver, you need to understand what this moment means for your position. If you don't, you need to understand why this asset class is suddenly appearing on the radar of institutional players who ignored it for years. This isn't about getting rich quickly. It's about understanding the economic forces reshaping global markets right now and how prepared investors navigate periods of structural change. My name represents years of studying market cycles, monetary policy, and investor behavior. I'm not here to sell you anything. I'm here to walk you through what's happening, why it matters, and how to think clearly when most people are reacting emotionally. Let's begin with what changed. For nearly 2 years, financial markets operated under a specific assumption. Central banks would raise interest rates, inflation would fall back to target levels, and the economy would achieve what policymakers call a soft landing. Stocks would stabilize, bonds would recover, the financial system would return to normal. That assumption is breaking down, not because of a single event, not because of one piece of data, but because the accumulated weight of economic reality is finally overwhelming the narrative that dominated financial media. The stock market, which rallied on the promise of rate cuts and renewed liquidity, now finds itself in an increasingly precarious position. Valuations remain historically elevated, even as corporate earnings face pressure. Credit conditions are tightening despite lower rates, and beneath the surface, the structural issues that caused inflation in the first place remain unresolved. This is where silver enters the conversation. Silver is not just an industrial metal, it's not just a precious metal. It occupies a unique position in the financial system, sitting at the intersection of monetary history and modern technology. Throughout history, when confidence in paper currencies declines, when debt levels become unsustainable, when the gap between asset prices and underlying economic reality widens too far, investors have returned to tangible stores of value. Gold gets most of the attention in these discussions, but silver, historically, has offered something different: greater volatility, greater upside potential, and critically, greater accessibility for everyday investors. Right now, several forces are converging that make silver's position particularly interesting. First, industrial demand continues to rise. Solar panels, electric vehicles, electronics, and emerging technologies all require silver in quantities that are difficult to substitute. This isn't speculation. This is measurable, structural demand that grows regardless of economic cycles. Second, silver inventories have been declining across major exchanges and vaults. The metal that's available for investment and industrial use is shrinking, even as demand from both sectors increases. Third, and perhaps most importantly, the monetary environment is changing in ways that favor hard assets over financial assets. Let me explain what I mean by that. Global debt has reached levels that would have been unthinkable 2 decades ago. Government debt, corporate debt, consumer debt, all accelerating at rates that far exceed economic growth. In the United States alone, the national debt now exceeds $36 trillion. Annual deficits continue to grow despite an economy that's supposedly healthy. Interest payments on that debt now consume more of the federal budget than defense spending. This isn't a political statement. These are accounting facts. When debt grows faster than the economy that supports it, only a few outcomes are possible. Either the debt is paid down through austerity and economic pain, or it's inflated away through currency debasement, or the system restructures through some form of default or crisis. History offers very few examples of the first option being chosen voluntarily. The political and social costs are simply too high, which means policymakers almost always choose some version of the second option. They print money, they suppress interest rates below the true rate of inflation. They allow currency values to erode gradually, transferring wealth from savers to debtors. This is not conspiracy theory. This is how sovereign debt crises have been managed for centuries. And when this process accelerates, when the gap between official inflation statistics and real purchasing power becomes too obvious to ignore, investors seek protection in assets that cannot be printed, debased, or inflated away. The stock market right now is sending conflicting signals, and that conflict itself is meaningful. On one hand, major indices remain near all-time highs. Technology stocks continue to command valuations that assume perpetual growth. Corporate buybacks provide consistent support for share prices. On the other hand, breadth is deteriorating. Fewer stocks are participating in rallies. Volatility is increasing. And certain sectors that typically lead during healthy expansions are showing weakness. This is classic late-cycle behavior. The market becomes increasingly dependent on a narrow group of stocks, while the broader economy shows signs of stress. What does this have to do with silver? Everything. When equity markets are this extended, when valuations are this stretched, the downside risk increases dramatically. A correction of 20% would merely bring valuations back to historical averages. A correction of 30 or 40% would take us into bear market territory, but still leave stocks well above 2020 levels. Smart investors don't wait for the correction to start thinking about portfolio protection. They prepare when markets are calm, when nobody's panicking, when assets like silver are still being ignored by the mainstream. Here's what most people get wrong about major market shifts. They wait for confirmation. They wait until the trend is obvious. They wait until financial media is finally talking about what's happening. By that time, the opportunity has passed. Silver's strongest moves don't happen when everyone's watching. They happen during transition periods when the fundamental case is building, but sentiment remains skeptical. Right now, we're in one of those periods. The economic data is mixed. Inflation remains above target, but below crisis levels. Employment is weakening, but not collapsing. Credit is tightening, but not frozen. This is the ambiguous middle phase where most investors remain paralyzed. They can see that something's changing, but they can't quite commit to adjusting their portfolios because the change isn't dramatic enough yet. Professional investors call this the slope of hope, the period where bad news is consistently reinterpreted as temporary setbacks rather than structural shifts. The investors who position themselves during this phase are the ones who benefit when the shift becomes undeniable. Let's talk about what happens to silver during periods of monetary stress and stock market weakness. In the 1970s, as inflation accelerated and confidence in the dollar declined, silver rose from under $2 per ounce to over $50 in 1980, a 25-fold increase in less than a decade. During the 2008 financial crisis, silver initially fell along with everything else as leveraged positions were liquidated. But within months, as central banks launched unprecedented stimulus programs, silver began a rally that would take it from $9 to nearly $50 by 2011. More recently, during the pandemic response of 2020, silver moved from $12 to nearly $30 in a matter of months, as money supply expansion reached historic levels. The pattern is consistent. During periods when currency creation accelerates, when debt levels explode, when financial markets become unstable, silver dramatically outperforms both stocks and bonds. We're not predicting that history repeats exactly, but we are saying that the conditions that drove those previous moves are reemerging. Money supply is no longer contracting. Deficit spending is accelerating. Central banks are trapped between inflation risks and financial stability concerns. These are the exact conditions that historically favor hard assets over paper assets. Beyond the monetary argument, silver has something gold doesn't have to the same degree: indispensable industrial applications in growing sectors. The solar industry alone is projected to consume over 200 million ounces of silver annually within the next few years. Electric vehicles require significantly more silver than traditional cars. The electronics industry continues to expand globally. This creates a supply-demand dynamic that's fundamentally different from gold. Gold is primarily held for monetary and jewelry purposes. Its industrial use is relatively minor. Silver must serve both industrial and investment demand from the same limited supply. And here's the critical point. When investment demand surges during periods of monetary uncertainty, it competes directly with industrial demand that doesn't disappear just because investors want silver for their portfolios. This dual demand creates the potential for price moves that are sharper and more dramatic than what we see in other commodity markets. Silver supply comes primarily from two sources: primary silver mining and secondary production as a byproduct of other mining operations. Primary silver mining is economically marginal at current prices. Most silver mines struggle to generate meaningful profits below $25 or $30 per ounce. This means that higher prices are actually necessary to incentivize the production needed to meet growing demand. But mining doesn't respond quickly to price signals. It takes years to develop new mines, obtain permits, build infrastructure, and begin production. Meanwhile, the byproduct silver from zinc, lead, and copper mining depends on the economics of those base metals, not silver itself. What this means is that silver supply is relatively inelastic. It doesn't respond quickly to changes in demand or price. On the demand side, we have the opposite situation. Industrial demand is growing and relatively price insensitive because silver represents such a small portion of the final product cost. And investment demand can surge rapidly when monetary conditions change. This is the classic setup for a supply-demand imbalance. If you're already holding physical silver, or silver through ETFs or mining stocks, you need to understand both the opportunity and the risks in front of you. The opportunity is that you're positioned ahead of what could be a significant revaluation in silver's price relative to both paper currencies and other financial assets. The fundamental case continues to strengthen. The technical setup is improving. The macroeconomic environment is shifting in silver's favor. But opportunities come with responsibilities. You need to manage position size appropriately. Silver is volatile. 20% moves in either direction over a few weeks are normal for this market. If you're overexposed, that volatility will test your discipline. You need to resist the temptation to trade around your position based on short-term price movements. The big money in silver is made by people who understand the cycle and have the patience to hold through the noise. You need to continue educating yourself about the forces driving this market. Don't become complacent just because you own the asset. Stay informed about monetary policy, industrial demand trends, and investor positioning. And most importantly, you need to have a plan, not a hope, not a vague expectation, a specific framework for how you'll manage the position as circumstances evolve. That means knowing at what point you might add to your position, knowing what conditions would cause you to reduce exposure, knowing what percentage of your overall portfolio this position represents, and why that allocation makes sense for your situation. Disciplined investors always think in terms of frameworks and probabilities, not predictions and certainties. If you don't currently own silver, you're facing a different question. Should you start a position, and if so, how? Let's be clear about something. Nobody should buy any asset based solely on what someone else says in a video. Not this one, not any other. You need to understand why you're making the investment. You need to understand the risks. You need to understand how it fits into your broader financial plan. That said, if you've studied the monetary situation, if you understand the supply-demand dynamics, if you recognize that portfolio diversification means more than just owning different stocks, then silver deserves your consideration. Starting a position doesn't mean going all in. It means allocating a percentage of your portfolio that makes sense, given your risk tolerance, time horizon, and financial goals. For many investors, that might mean 5 to 15% of investable assets in precious metals overall, with silver representing a portion of that allocation. The method of exposure matters too. Physical silver provides direct ownership, but comes with storage considerations. ETFs offer liquidity and convenience, but introduce counterparty risk. Mining stocks offer leverage to silver prices, but come with company-specific risks. Each approach has trade-offs. The right choice depends on your specific situation. What's important is that you make the decision thoughtfully, not emotionally, not because prices are spiking and you're afraid of missing out, not because someone on social media posted their gains. The best positions are built when you have time to think clearly, when you can accumulate gradually, when you're not reacting to fear or greed. Let's talk about what not to do, because understanding how people destroy wealth is just as important as understanding how they build it. Don't over-leverage. Silver's volatility makes leverage positions extremely dangerous. What looks like a small pullback in percentage terms can trigger margin calls and force you out of your position at exactly the wrong time. Don't try to time every move. You will not catch the bottom perfectly. You will not sell at the top. Attempting to do so will cause you to miss the major trend while accumulating transaction costs and tax liabilities. Don't follow online hype blindly. Social media is filled with people posting positions, making predictions, and claiming expertise they don't have. Some are genuinely knowledgeable. Many are not. Some are deliberately trying to manipulate you. Your job is to understand the fundamentals yourself, not to outsource your thinking to strangers on the internet. Don't ignore the rest of your financial life. Silver is a piece of a portfolio, not a replacement for emergency funds, insurance, debt management, or career development. Get those fundamentals right first. Don't expect silver to move in a straight line. There will be corrections. There will be periods where it feels like nothing's happening. There will be moments where you question the entire thesis. That's normal. That's how markets work. The investors who succeed are the ones who understand this going in and prepare for it, emotionally and financially. Serious analysts are monitoring several specific indicators right now that tell us where this situation might be heading. They're watching the behavior of central banks, particularly those in emerging markets who have been accumulating gold and silver at rates not seen in decades. When institutions that control billions of dollars start moving toward hard assets, that's a signal worth noting. They're watching the ratio between gold and silver prices. Historically, this ratio tends to compress during periods of monetary stress, meaning silver catches up to gold's gains. Right now, that ratio remains elevated by historical standards, suggesting silver has room to move. They're watching industrial inventory levels and manufacturing data to understand how demand is evolving in real time. They're watching currency markets, particularly the dollar's strength relative to other major currencies, because silver tends to move inversely to dollar strength over longer periods. They're watching credit markets for signs of stress that might force central banks back into aggressive easing. None of these indicators provides perfect predictions. Markets are complex adaptive systems, not clockwork mechanisms. But collectively, these signals help informed investors understand whether the probabilities are shifting in favor of their thesis or against it. Right now, the weight of evidence continues to tilt toward an environment where silver outperforms traditional financial assets. Step back for a moment from silver specifically and consider what's really happening in the global economy. We're in the late stages of a debt supercycle that began decades ago, a period where borrowing and money creation were consistently used to solve every economic problem, pushing real structural reform further into the future. That strategy worked for a long time, It delivered growth, stability, and rising asset prices, but it also created fragility. It made the system dependent on continuous credit expansion. It required interest rates to remain artificially low. It built enormous obligations that now burden every major economy. At some point, that cycle ends, not because anyone wants it to, but because the mathematics eventually override the politics. We may be approaching that inflection point now, not tomorrow, not next week, but somewhere on the horizon that's closer than most people realize. When that transition happens, when the gap between financial asset prices and economic reality narrows, when confidence in paper currencies wobbles, hard assets become the bridge that allows wealth to cross from one era to the next. This is why silver matters beyond just the potential for price appreciation. It represents insurance against outcomes that seem unlikely until they're inevitable. Let's be honest about something. We don't know exactly when silver makes its major move. We don't know how high it goes. We don't know what specific catalyst triggers the shift from gradual appreciation to dramatic revaluation. What we do know is that the fundamental case continues to strengthen, that the supply-demand imbalance is real and measurable, that the monetary environment is creating conditions similar to previous periods when silver dramatically outperformed. What we also know is that waiting for certainty means waiting until the opportunity has passed. This doesn't mean gambling. It means positioning appropriately based on probabilities, not certainties. It means having enough exposure that you benefit if the thesis proves correct, but not so much that you're devastated if it doesn't play out as expected. It means staying flexible enough to adjust as new information emerges. This is how professional investors think. In terms of risk-adjusted returns, in terms of portfolio construction, in terms of scenarios and probabilities, not in terms of guaranteed outcomes or can't-miss opportunities. Perhaps the most important quality an investor can develop is patience, not passive waiting, active patience. The discipline to hold positions that you've researched and understand even when they are not moving. Silver has frustrated more investors than almost any other asset precisely because of this dynamic. Long periods of consolidation followed by explosive moves. Extended ranges that test conviction, volatility that shakes out weak hands right before major trends begin. The investors who succeed in this market are the ones who understand that patience is not just sitting still, it's continuing to learn. It's monitoring your thesis against new data. It's managing your emotions when prices move against you temporarily. It's recognizing that the absence of immediate gratification doesn't mean the thesis is wrong. Some of the best investments require years to play out fully. But for those with the discipline to hold them, the results can be extraordinary. In today's information environment, you can drown in data, opinions, and analysis. You can spend hours every day consuming content about silver and markets and never actually improve your understanding. The key is developing a disciplined approach to information consumption. Follow a few trusted sources who demonstrate genuine expertise and intellectual honesty. Ignore the noise from people who are trying to manipulate your emotions or sell you something. Understand the difference between news and analysis. News tells you what happened. Analysis helps you understand what it means. Check in on your positions regularly, but don't obsess over daily price movements. Silver's day-to-day volatility is meaningless noise. The weekly and monthly trends are what matter, and perhaps most importantly, stay grounded in the fundamentals. Price action is information. Sentiment is information. But neither changes the underlying supply-demand dynamics or the monetary reality driving this market. When you focus on fundamentals, you can tolerate volatility. You can think clearly when others are panicking. You can make rational decisions instead of emotional reactions. Many investors view silver mining stocks as a way to gain leveraged exposure to silver prices. This can work, but it comes with additional complexities. Mining companies are businesses with their own specific risks. Management quality matters. Cost structures matter. Political and jurisdictional risks matter. Capital allocation matters. A rising silver price doesn't automatically mean every mining stock performs well. Some companies are poorly managed. Some have high costs that eat into margins. Some face operational challenges that prevent them from benefiting from higher prices. If you choose to invest in mining stocks, you need to evaluate the companies themselves, not just the metal they produce. You need to understand their all-in sustaining costs, their reserve quality, their jurisdictional risks, their balance sheet strength. This requires a different skill set than simply understanding the silver market. For many investors, the simplicity and direct exposure of physical silver, or ETFs, makes more sense than trying to pick individual mining stocks. There's no right or wrong answer here, only trade-offs that need to be understood and accepted. The honest answer is that we don't know precisely what happens next. Markets don't follow scripts. Economic cycles don't respect predictions. What we can say is that the conditions are in place for silver to significantly outperform over the next several years. The debt situation continues to worsen. Central banks remain trapped between impossible choices. Industrial demand continues to grow. Supply remains constrained. These facts don't guarantee any specific outcome, but they shift the probabilities meaningfully in favor of higher silver prices. Your job as an investor is not to predict the future. It's to position yourself intelligently based on probabilities and manage your risk appropriately. It's to stay informed without being overwhelmed, to remain disciplined without being stubborn, to hold conviction without becoming dogmatic. These are the qualities that separate successful long-term investors from those who are whipsawed by market volatility and emotional reactions. So where does this leave you? If you hold silver, continue to monitor your position. Make sure your allocation still makes sense given your overall financial situation. Have a plan for how you'll manage the position as it evolves. If you don't hold silver, consider whether the case we've outlined aligns with your understanding of economic and market risks. If it does, think about how you might establish a position in a disciplined, measured way. Either way, stay focused on what you can control. You can't control silver prices, you can't control central bank policies, you can't control global economic events, but you can control your position sizing. You can control your emotional reactions. You can control how much time you invest in understanding these markets. You can control whether you make decisions based on research or impulse. That's where your power as an investor actually lies. We're living through a period of significant economic transition. The financial system that delivered stability and growth for decades is showing signs of strain. The solutions that worked in the past are producing different results now. This creates both risk and opportunity. Silver sits at the intersection of these forces, a monetary metal with deep historical significance, an industrial commodity with growing technological demand. A market small enough that relatively modest capital flows can move prices dramatically. Understanding this doesn't mean you'll perfectly time your entry or exit. It doesn't guarantee profits. It doesn't eliminate risk. But it gives you a framework for thinking clearly when others are confused, for acting decisively when others are paralyzed, for maintaining discipline when emotions are running high. That framework, more than any specific trade or position, is what separates investors who build wealth over time from those who are constantly reacting to circumstances. The stock market may indeed be hanging by a thread. The traditional playbook may be breaking down. The easy money and financial assets may be behind us. But for those who understand cycles, who study history, who maintain discipline, who think in probabilities rather than certainties, these transitions are not just risks to be feared. They're opportunities to be prepared for. Stay informed. Stay disciplined. Stay focused on what matters. The crisis is here, but so is the opportunity. The question is whether you'll be ready when the shift becomes undeniable. Thank you for your time and attention. Now go do your own research. Build your own understanding. Make your own decisions. That's how wealth is truly built.